There you have it, the closing bell at the New York Stock Exchange. And they're cheering, but the Dow is down. It started the day up more than 300 points, but clearly that did not last. We're now seeing the Dow down about 200 points at close. The S&P and the Nasdaq both down by a little under a percentage point. Of course, economists are watching to see what happens with inflation. The Fed has signaled it could raise interest rates again by 0.75 of a percentage point in an effort to tackle rising prices. Let's bring in Matt Luzzetti. He's a senior U.S. economist at Deutsche Bank. Matt, how likely is it that you think the Fed will pursue another rate hike? And what should Americans do to prepare themselves if the Fed does go down that path?
Sure. First, thanks so much for having me. I think it's very likely that the Fed raises rates by another 75 basis points or 0.75 of a percentage point at next week's meeting. After the latest inflation data came in much stronger than expected, the market was actually moving to price a full percentage point rate hike. We heard from Fed officials after that they were more likely to pursue the somewhat slimmed down version, but still 75 basis points is the highest that we've seen since 1994 in terms of rate hikes from the Fed. I think you're going to continue to see the Fed moving aggressively here. We're seeing headline inflation at 9.1%, really the highest in 4 decades. The underlying drivers of the inflation data that we're seeing is more demand driven. It's more broad based. And so the Fed, I think, is almost looking at this as an existential question for them, being able to get inflation down over time by tightening monetary policy. For households, it does mean interest rates are going to continue to rise, but the market is really pricing this aggressive path from the Fed. And so raising rates by 75 basis points next week would really not come as a surprise from the market's perspective.
But the market, you said, was expecting the Fed to raise rates by a full percentage point. Why would they go for 0.75 of a percentage point?
So there was some movement in that direction after the CPI report last week. But as Fed officials came in and kind of pushed back on that notion, we now have a market that's pricing much closer to 75 basis points. And kind of interestingly, the market had a relief rally last week after it was viewed as less likely for the Fed to move by 100 basis points. Given where inflation is, it is an important question. Will the Fed begin to move even more aggressively than what they're signaling? I think for the moment, they've said that they can do a lot by simply going by 75 basis points. And we also have not only very high inflation, but we have some concerns on the growth front. Recession risks. We think the economy enters into a recession next year. And so the Fed is really trying to balance these two things, really high inflation, but concerns about recession risks over the next 12 months. So
that's a big question. Could raising rates trigger a recession? Of course, raising rates would incentivize people to keep money in their bank accounts, not spend it, try to slow down the economy a bit, cool the economy off by, just disincentivizing Americans from spending money. Where do you think we are in terms of the likelihood of a recession if the Fed raises rates by 0.75 of a percentage point?
Sure. So I think it's very interesting times from a macro perspective. It looks like the economy in the first half of the year was in a technical recession, 2 consecutive quarters of negative GDP growth. But at the same time, we've had a very strong labor market. The economy has added 450,000 jobs per month on average, and the unemployment rate has stayed at 3.6%, near the lowest levels over the past 50 years or so. And so the economy, while it may have been in a recession the first half of the year, isn't really showing any of those signs. We do think that the path toward a soft landing, the Fed being able to get inflation down but not triggering recession, is a very, very narrow one for the Fed. We think that this most likely does end with a recession as the Fed raises rates. And it is the goal of the Fed to get demand down in order to bring price pressures down over time. Our baseline is that through next year, around the middle of the next year, is when we really begin to see Fed's monetary policy tightening taking hold, the labor market really begin to weaken, the unemployment moving higher, and the real kind of conventional recession happening around the middle of next year.
And what does that mean in terms of how average Americans will be feeling at this conventional recession next year versus the technical recession we've already had, although we're not necessarily feeling it when we look at, a strong labor market?
Yeah, haven't been feeling it from a strong labor market perspective. Wage growth has been strong, the unemployment rate low. But I think certainly what households are feeling are price pressures. So that 9.1% headline inflation that we've seen over the past year, particularly with being in the energy and food sectors, has really taken a bite. It means that real income growth for households is negative. I think that's one key reason why we see sentiment at so low levels for consumers in the U.S. Also, business sentiment at very low levels.
Yeah.
And so going forward, it's one where once the labor market really begins to weaken, I think that's when it's, from a household perspective, you have relatively elevated inflation at the same time where the labor market begins to weaken. That's what we think happens next year. That's obviously a very difficult environment for households.
All right, Matt Luzzetti with the important information. Thank you so much.
Thank you.